December 2025. While most people were focused on holiday shopping and year-end celebrations, something shifted in the world's largest financial institutions. Something that got almost no mainstream coverage. Vanguard, the world's second largest asset manager with over $9 trillion under management, just told investors to flip their portfolios upside down. For decades, the 60-40 portfolio was the gold standard. 60% stocks, 40% bonds. Every financial advisor preached it. Every retirement plan defaulted to it. It was the safe, boring, reliable allocation that built middle-class wealth for 40 years. Vanguard just said, abandon it. Go 40-60 instead. 40% stocks, 60% bonds. Cut your equity exposure by a third. Move defensive. Reduce risk. Roger Aliaga Diaz, Vanguard's global head of portfolio construction and chief economist for the Americas, used a specific phrase to describe this shift. He called it a tectonic shift. Not a minor adjustment, not routine rebalancing, a tectonic shift. Those were his exact words to the financial press in December 2025. When one of the most conservative, most data-driven asset managers on the planet uses language like that, you pay attention. But here's the part nobody is connecting. This recommendation did not come out of nowhere. Vanguard's own projections show that a 40-60 portfolio now delivers nearly identical returns to a 60-40 portfolio. The 40-60 has an expected 10-year annualized return of 5.7%. The traditional 60-40, just 5.3%. Almost the same returns. But the volatility on the 40-60 is 6.9% compared to 9.3% for the 60-40. Lower risk, same reward. That tells you something is broken. The risk-reward math that worked for 4 decades has changed. Stocks are no longer paying investors enough for the extra risk they carry. And Vanguard is not alone. BlackRock, the largest asset manager in the world with over $10 trillion in assets, released their 2026 outlook in December. They warned that persistent inflation dynamics, policy action, and fiscal imbalances have fundamentally altered portfolio risk profiles. They said this regime may endure. These are not small hedge funds chasing headlines. These are the institutions that manage your 401k, your pension, your retirement. They are moving. They are repositioning. They are preparing for something. The question is, what do they see coming that most people do not? The answer starts with a number that crossed a threshold most Americans have not fully processed yet. $38.43 trillion. That is the current United States national debt as of January 7th, 2026. And what is happening with that debt explains everything these institutions are doing right now. $38.43 trillion. That is not a projection. That is not a forecast. That is the actual number from the U.S. Treasury as of January 7th, 2026. Let me put that in perspective. It took the United States 200 years to accumulate its first $2 trillion in debt. From 1776 to 1986, 2 centuries of wars, recessions, the Great Depression, 2 world wars, Korea, Vietnam, 200 years to reach $2 trillion. In 2025, the federal government added $2 trillion in just 10 months and 18 days. This is the 3rd consecutive year the debt has grown by more than $2 trillion, not during a crisis, not during a war, during what economists call a period of economic growth. The Joint Economic Committee of Congress tracks this data daily. Their numbers show the debt is increasing at a rate of $8.03 billion per day. That breaks down to $334 million per hour, $557 million per minute, 92 9/12s every single second. While you have been watching this video, the national debt has increased by roughly $500,000. At this pace, the U.S. will cross $39 trillion by April 2026, 3 months from now. But here's the number that matters more than the debt itself, $970 billion. That is how much the federal government paid in interest on the national debt in fiscal year 2025, not paying down the principal, not reducing what we owe, just the interest. In fiscal year 2020, interest payments were $345 billion. 5 years later, they have nearly tripled. The Congressional Budget Office projects interest payments will cross $1 trillion in fiscal year 2026. By 2035, they project $1.8 trillion annually. Over the next decade, the government will pay $13.8 trillion just in interest. That is more than 3 times what it paid in the previous decade. Interest on the debt is now the 2nd largest line item in the federal budget, larger than defense spending, larger than Medicare, larger than every federal program except Social Security. The Committee for a Responsible Federal Budget put it bluntly in December 2025. $1 trillion interest payments are the new norm. Now let me make this personal. The gross national debt per household in America is $285,927. Per person, it is $112,966. The increase over the past year alone amounts to $16,119 per household. The average American household spent $6,500 on healthcare last year. $2,600 on home furnishings, $500 on gasoline, $2,200 on clothing, their share of federal interest payments, $7,300. The government's cost of borrowing now exceeds what typical families spend on their own health. And this is happening during the good times. Low unemployment, GDP growth, stock markets near all-time highs. What happens when the next recession hits? When tax revenues drop? When spending increases automatically through unemployment benefits and stimulus programs? The debt does not pause. The interest does not wait. The math does not care about elections or politics or who controls Congress. Every month, the Treasury must refinance maturing debt and issue new bonds to cover the deficit. Every month, more of the budget goes to interest instead of roads, research, defense, or anything else. This is not a problem for future generations to solve. This is a problem compounding right now, in real time, at $92,000 per second. The institutions managing trillions of dollars see these numbers. They run the projections. They know what happens when debt compounds faster than the economy grows. That is why they are moving. But to understand where this leads, you need to understand that this pattern has played out before. Not once, not twice. But every single time a government has tried to spend its way past fiscal reality. The pattern is predictable, the stages are consistent, and the outcome has never varied. Every monetary system that has ever failed followed the same pattern. This is not opinion. This is documented history across civilizations, centuries, and continents. The Roman Empire, Weimar Germany, the Holy Roman Empire, Argentina, Zimbabwe, Venezuela, Turkey, Lebanon. Different cultures, different technologies, different political systems. Same pattern, same stages, same outcome. 4 stages, every time. Stage 1 is the foundation. Every system begins with sound money, currency backed by something real, gold, silver, a commodity that cannot be created from thin air. The government collects taxes and spends what it collects, maybe a little more during emergencies. But the budget stays roughly in balance because the money supply is constrained by physical reality. Citizens trust the currency because it holds value. Merchants accept it because they know it will buy the same amount of goods tomorrow as it does today. Trade grows naturally. The economy expands. Wealth accumulates. This is the stable phase, the foundation that makes everything else possible. Stage 2 is expansion and debasement. Something changes. A war. A crisis. An ambitious infrastructure program. A new social obligation. The government's appetite begins to exceed its income. Raising taxes is politically difficult. The population resists. But the spending must continue. Promises have been made. Obligations are mounting. So someone discovers the shortcut. Instead of collecting more revenue, the government creates more money. In ancient times, they reduced the precious metal content in coins. Today, they print currency or add digits to accounts at the central bank. At first, no one notices. The debasement is small, 5%, maybe 10%, just a temporary measure to get through the current crisis. The currency still looks the same. The numbers on the bills have not changed. Life continues normally. But the government has crossed a line. They have learned how to spend without taxing, how to create purchasing power without creating value, how to make promises without constraints. Once discovered, this power is almost impossible to resist. Stage 3 is crisis and loss of control. The debasement accelerates. What started as 5% becomes 20%, then 40%. Each round of spending requires more money creation. Each round of money creation makes the next crisis worse. Prices begin rising, slowly at first, then faster. Citizens notice their savings buying less each year. Merchants start raising prices to protect themselves. Workers demand higher wages. The government responds by creating even more money to meet its obligations. A feedback loop takes hold. More spending requires more money creation. More money creation causes more inflation. More inflation increases the cost of government programs. Higher costs require more spending. The cycle feeds itself. Trust begins to erode. People start moving savings into real assets. Property, commodities, foreign currencies, anything that holds value independent of government promises. The government typically responds with controls, price caps, capital restrictions, mandatory acceptance laws, penalties for hoarding. These measures always fail. You cannot legislate confidence. You cannot mandate trust. You cannot force people to believe in a currency they have watched lose value year after year. Stage 3 can last years or decades, but the direction is set. The destination is fixed. The mathematics are working against the system. Stage 4 is the reset. The currency either hyperinflates into worthlessness or gets abandoned entirely. The government loses its ability to fund basic functions. Trade breaks down, economic activity contracts, social order strains. Those who saw it coming and positioned in real assets preserve their wealth. Those who held government promises and currency watch their savings evaporate. Eventually, a new system emerges, usually backed by sound money again. The cycle resets. And within a few generations, when the memory of collapse has faded, the pattern begins once more. This is not theory I invented. This is the documented trajectory of monetary failure across human history. And the clearest example lasted 500 years, involved the most powerful empire the world had ever seen, and left records detailed enough that we can track the debasement year by year, emperor by emperor, percentage point by percentage point. Rome. 211 BC. The Roman Republic introduces a new silver coin called the denarius. The word means containing 10 because it equals 10 bronze asses. The coin weighs 4.5 grams of silver at roughly 95% purity, nearly pure. A soldier's daily wage, a craftsman's earnings. The backbone of Roman commerce for the next 5 centuries. At its peak, the Roman Empire controls all of Western Europe, North Africa, and the Middle East. 65 million people, 20% of the world's population. The denarius circulates from Britain to Mesopotamia. It is the reserve currency of the ancient world. For 2 centuries under the Republic, the denarius maintains its weight and purity. The system works. Trade flourishes. Rome expands. The foundation holds. Then comes stage 2. 64 AD. Emperor Nero faces a budget crisis. Military campaigns are expensive. The Great Fire of Rome has destroyed 2/3 of the city. Nero's personal spending is extravagant. Tax revenues cannot cover the obligations. Nero makes a decision that will echo through history. He reduces the denarius from 4.5 grams to 3.8 grams. He drops the silver purity from 98% to around 90%. A 20% debasement in a single move. For every million denarii collected in taxes, Nero can now mint 1.2 million new coins. Instant revenue. No tax increase required. The citizens barely notice. The coins still look like silver. They still spend like silver. But something has changed. Kenneth Harl, a professor of classical history, described the trap Nero created. Public faith in imperial coins made possible the policies of debasement that eventually eroded the Augustan currency. The trust built over 2 centuries of sound money now enabled its destruction. Subsequent emperors followed Nero's example, each one debased a little more. Under Trajan, around 100 AD, silver content dropped to 85%. Under Marcus Aurelius, the philosopher emperor, it fell to 75%. Under Septimius Severus in 200 AD, the denarius contained just 50% silver. Each emperor rationalized his debasement as a temporary necessity. Wars to fight, borders to defend, soldiers to pay. The Roman grain dole fed hundreds of thousands of citizens. The costs kept rising. The silver content kept falling. Stage 3 arrived in the 3rd century. In 215 AD, Emperor Caracalla introduced a new coin called the Antoninianus. It had a face value of 2 denarii, but contained only 1.6 times the silver. The government declared it worth double while giving people 80% of the metal. Gresham's law took effect immediately. People hoarded the old denarii with higher silver content and spent the new debased coins. The good money disappeared from circulation. The bad money remained. By 250 AD, the Antoninianus contained barely 40% silver. By 270 AD, it was down to 4%. By the end of the 3rd century, Roman coins were bronze, with a thin silver wash that wore off within weeks. Citizens could literally see the fraud rubbing off in their hands. Prices exploded. Goods that cost 1 denarius now cost 50, then 100, then 1,000. In 301 AD, Emperor Diocletian issued the edict on maximum prices, price controls on over 1,000 goods and services. The penalty for charging more than the approved price was death. It failed completely. Merchants refused to sell at mandated prices. They would rather close their shops than trade at a loss. Black markets emerged everywhere. Barter replaced currency. Soldiers demanded payment in goods instead of worthless coins. The monetary system collapsed. 1 denarius in 85 AD bought a day's labor from a skilled craftsman. By 301 AD, according to Diocletian's own price edict, the same goods cost 6,300 debased denarii. That is 6,300% inflation over 200 years, with most of it concentrated in the final decades. To put Rome's debasement in gold terms, during Julius Caesar's time, 1 gold aureus equaled 25 denarii. By 330 AD, 1 gold solidus purchased hundreds of thousands of denarii. By the empire's final years, 1 gold coin bought millions. The social consequences went beyond economics. Tax evasion became universal. Why pay invaluable goods to receive worthless coins? Central authority weakened. Regional strongmen emerged. The professional legions that had conquered the known world could no longer be paid reliably. The crisis of the 3rd century, from 235 to 284 AD, saw the empire nearly collapse. Civil wars, barbarian invasions, plague, economic breakdown. In one 50-year stretch, Rome had over 20 different emperors, most killed by their own troops. The Western Roman Empire limped on for another 2 centuries before its final collapse in 476 AD. But the trajectory was set in 64 AD when Nero made that first reduction. Stage 1 to Stage 4, sound money to worthless tokens, 500 years of the most powerful empire in history, undone by the same pattern that repeats across civilizations. The Romans left detailed records. We can track the silver content of their coins decade by decade. We can map the debasement against military defeats, political assassinations, and economic crises. The correlation is exact. The pattern is clear. But Rome took centuries to collapse. Modern systems move faster. In the 20th century, the same pattern played out in 14 years. Rome's collapse took centuries. Weimar Germany went through the same 4 stages in 14 years. Before World War I, the German mark was one of the strongest currencies in Europe. Backed by gold, stable, trusted. 4 marks bought $1. German industry was world-class. The economy was growing. The foundation was solid. Stage 1, then came the war. Germany financed World War I almost entirely through borrowing. By 1918, the national debt stood at 156 billion marks. The government assumed victory would bring reparations from defeated enemies to pay off the debt. Germany lost. The Treaty of Versailles imposed 132 billion gold marks in reparations, an impossible sum designed to cripple Germany for a generation. The new Weimar Republic inherited a shattered economy, a demoralized population, and a debt it could never repay through taxation alone. Stage 2 began immediately. By late 1920, the exchange rate had slipped from 4 marks per dollar to 70 marks. By late 1921, it reached 180 marks. The government was printing money to cover its obligations, not aggressively yet, just enough to bridge the gap between what it collected and what it owed. The trajectory was set. In January 1922, Germany missed a reparation payment. France and Belgium responded by occupying the Ruhr Valley, the industrial heartland of Germany. Coal mines, steel mills, factories, the engine of the German economy, seized by foreign troops. The Weimar government ordered workers to resist. Passive resistance. Do not cooperate. Do not work. Strike. But striking workers still needed to be paid. Industrial output collapsed. Tax revenue evaporated. The reparations were still due. The occupying forces were not leaving. The government did what failing governments always do. It printed. In January 1923, $1 cost 17,000 marks. High, but manageable. People still used marks for daily transactions. By May, $1 cost 48,000 marks. By July, 350,000 marks. By August, 4.6 million marks. The government outsourced money printing to 133 private companies. The presses ran 24 hours a day. They could not print fast enough to keep up with the spending. By October 1923, the monthly inflation rate hit 29,500%. Prices doubled every 3.7 days. Let me show you what that looked like in a grocery store. A loaf of bread cost 163 marks in January 1923. By May, it cost 200 marks. By July, 100,000 marks. By September, 2 million marks. By October, 670 million marks. By November, 80 billion marks. One loaf, 80 billion marks. The same pattern held for everything. A kilogram of beef cost 1,800 marks in January. By November, 4.8 trillion marks. Workers demanded to be paid twice a day so they could spend their wages before the money lost more value. Wives waited outside factories at noon to collect the first payment and rushed to buy groceries before prices rose again by evening. People carried wheelbarrows full of cash to buy basic goods. A student ordered a cup of coffee for 5,000 marks. By the time he finished drinking it and ordered a second cup, the price had risen to 7,000 marks. Banknotes became wallpaper. They were cheaper than actual wallpaper because the paper itself cost more to manufacture than the currency printed on it. Shopkeepers could not replenish inventory fast enough. Farmers refused to sell produce for worthless paper. They would rather let crops rot than accept marks. Food riots broke out. Townspeople marched into the countryside to loot farms. The savings of the middle class were obliterated. A pensioner who had saved carefully for 40 years found his entire life his savings could not buy a loaf of bread. Widows starved. The social contract shattered. By November 20th, 1923, the exchange rate reached 4.2 trillion marks per dollar. 4 trillion. That is a 4 followed by 12 zeros. In January 1923, $1 bought 17,000 marks. In November 1923, $1 bought 400,000 marks. A 247 million% collapse in 11 months. The German government finally abandoned the mark entirely. On November 15th, 1923, they introduced a new currency called the Rentenmark, backed by land and mortgages instead of gold. 1 Rentenmark equaled 1 trillion old marks. The hyperinflation stopped, but the damage was permanent. An entire generation watched their savings, their pensions, their security evaporate in less than a year. The middle class was destroyed. Trust in democratic institutions collapsed. Extremism surged from both the far left and far right. 10 years later, Adolf Hitler became Chancellor of Germany. Historians still debate how much the hyperinflation contributed to the rise of the Nazi Party. But no one disputes that November 1923 broke something in the German psyche. The experience of watching money become worthless, watching a lifetime of work disappear, watching the government print its way to catastrophe. That experience shaped German politics for the rest of the century. To this day, the German central bank remains one of the most inflation-averse institutions in the world. The memory is that deep. Same pattern as Rome. Stage 1 to stage 4. Sound money to worthless paper. But Weimar happened in years, not centuries. Modern financial systems move faster. The feedback loops are tighter. The collapse, when it comes, is sharper. Rome and Weimar are the two most documented examples. But the pattern is not limited to them. It is repeated across continents and centuries in systems large and small. And right now, the largest financial system in human history is following the same trajectory. So where is the United States right now? Let me map it against the 4 stages. Stage 1 ended in 1971. That was the year President Nixon closed the gold window. Before that decision, foreign governments could exchange dollars for gold at a fixed rate of $35 per ounce. The dollar was anchored to something physical, something that could not be created by committee vote. After August 15th, 1971, the dollar became pure fiat currency. Its value rested entirely on trust, on the belief that the U.S. government would manage it responsibly. For the first time in history, the global reserve currency had zero intrinsic backing. Stage 2 has been running for 54 years. In 1971, the national debt was $398 billion. Today, it is $38.43 trillion. That is a 9,500% increase, a 96-fold expansion. But the acceleration is what matters. The debt crossed $34 trillion in January 2024. It hit $35 trillion in July 2024, $36 trillion in November 2024, $37 trillion in August 2025, $38 trillion in October 2025, $1 trillion every 5 months. During peacetime, during economic growth, during the good times. The Congressional Budget Office projects debt held by the public will reach 120% of GDP by 2035. Under alternative scenarios that assume current temporary provisions become permanent, it could hit 134% of GDP. The Government Accountability Office put it plainly in their February 2025 fiscal report. The federal government faces an unsustainable fiscal future. They projected that if nothing changes, debt will reach 200% of GDP by 2047, twice the size of the entire economy. But here's the number that tells you we have entered stage 3. $970 billion in interest payments for fiscal year 2025. 5 years ago, in 2020, interest payments were $345 billion. They have nearly tripled. The Congressional Budget Office projects interest will cross $1 trillion in fiscal year 2026. By 2035, it will reach $1.8 trillion annually. Over the next decade, total interest payments will exceed $13.8 trillion. Interest on the debt is now the second largest federal expense. It exceeds the entire defense budget. It exceeds Medicare. Only Social Security costs more. And here is what makes this stage 3 rather than late stage 2. The interest payments themselves are contributing to the debt. In the first quarter of fiscal year 2026, the Treasury spent $276 billion on interest. That is $30 billion more than the same period a year earlier. The Committee for a Responsible Federal Budget calculated that the entire increase in federal spending during that quarter was absorbed by interest costs. The government is borrowing money to pay interest on money it already borrowed. The debt is compounding. This is the feedback loop that defines stage 3, the same dynamic that accelerated Rome's decline in the 3rd century. The same spiral that destroyed the German mark in 1923, and the institutions that manage trillions of dollars see it clearly. Vanguard's December 2025 outlook stated it directly. U.S. equities are overvalued, the risk-reward ratio has broken down. Bonds now offer similar returns with lower volatility. Roger Aliaga-Diaz, their chief economist for the Americas, explained the math. What you have is a compression of the equity premium. It is almost that the market does not really reward for the extra risk of stocks. The 40-60 portfolio Vanguard now recommends has an expected 10-year return of 5.7%. The traditional 60-40 portfolio has an expected return of 5.3%. Nearly identical returns. But the volatility on 40-60 is 6.9% versus 9.3% for 60-40. Significantly lower risk for the same reward. That tells you the risk premium for equities has collapsed. Stocks are no longer paying investors adequately for the danger they carry. Vanguard's projections show international stocks outperforming U.S. stocks over the next decade. Their expected return range for non-U S developed markets is 5.1% to 7.1% annually, higher than their U.S. equity forecast. That is not anti-American sentiment. That is mathematical analysis. U.S. valuations are stretched. The debt burden is growing. The fiscal trajectory is unsustainable. BlackRock's 2026 outlook echoed the same concerns. They warned that persistent inflation dynamics, policy action, and fiscal imbalances have fundamentally altered portfolio risk profiles. They said traditional diversifiers are faltering because long-term treasuries no longer offer the portfolio ballast they once did as high debt keeps yields elevated. Read that again. The world's largest asset manager is saying U.S. government bonds no longer function as safe havens because the debt is too high. BlackRock noted that stock-bond correlations have shifted from reliably negative to persistently positive. For decades, when stocks fell, bonds rose. That relationship provided natural portfolio protection. When equities dropped, fixed income cushioned the blow. That relationship is broken. Stocks and bonds now often move in the same direction. When markets fall, there is no automatic hedge. BlackRock attributes this to deeper structural forces, including fiscal imbalances. They believe this regime may endure. These are not fringe voices. Vanguard manages $9 trillion, BlackRock manages $10 trillion. Together, they oversee more assets than the GDP of every country on Earth, except the United States and China. When institutions of this scale shift their positioning and publicly warn about fiscal imbalances, that is not marketing. That is risk management. They are telling their clients, in plain language, that the system is entering a more dangerous phase. The parallels to Rome and Weimar are not exact. History does not repeat perfectly, but the pattern rhymes. A government spending beyond its means, a currency being debased to cover the gap, debt compounding faster than the economy grows, interest payments consuming an ever larger share of the budget, institutions quietly repositioning for what comes next. The question is not whether the pattern is playing out. The data confirms that it is. The question is what stage we are in and how long stage 3 lasts before the math forces a resolution. Now let me address the 3 arguments you will hear from people who dismiss this analysis. The first, this time is different. Every failing system believes it is different. Every empire, every currency, every government that has ever debased its money thought it had found the exception to the rule. Rome believed its empire was eternal, the greatest civilization in human history, roads spanning 3 continents, legions that had never been defeated, an administrative system copied by every successor state for 1,000 years. Rome fell. Weimar Germany believed its modern industrial economy could absorb the shock. Germany had the most advanced engineering in Europe, the best universities, the most productive factories, the most educated workforce. The mark became wallpaper. The United States has real advantages, the world's largest economy, the global reserve currency, the most powerful military, deep capital markets, rule of law, property rights, institutions that have functioned for 250 years. None of these advantages change the mathematics of compound interest. $38 trillion in debt growing at $8 billion per day. $1 trillion in annual interest payments rising to $1.8 trillion by 2035. Deficits projected to continue indefinitely regardless of which party controls Congress. The advantages do not make America immune to the pattern. They just mean the adjustment, when it comes, will be larger, more consequential, more disruptive to global markets. Reserve currency status is not permanent. Britain held that position before America. Spain held it before Britain. The Dutch before Spain. The pattern of monetary hegemony shifting from one power to another is itself a pattern that is repeated throughout history. This time is different, is what people say right before they discover it is not. The second objection, technology will save us. Artificial intelligence, automation, productivity gains. The argument is that technological advancement will generate enough economic growth to outpace the debt. Technology does not change mathematics. The Roman Empire had the ancient world's most advanced engineering. Concrete that modern scientists still cannot fully replicate, aqueducts that functioned for centuries, roads that exist to this day, the Colosseum, the Pantheon, engineering achievements that would not be matched for 1,000 years. Technology did not save Rome from currency debasement. Weimar Germany had cutting-edge industrial technology. The printing presses that destroyed the mark were themselves technological marvels, capable of producing banknotes faster than any previous generation could have imagined. Technology accelerated the collapse. It did not prevent it. The United States has extraordinary technological capabilities. AI may indeed transform productivity over the coming decades, but productivity improvements do not eliminate the gap between spending and revenue. They do not pay down existing debt. They do not reduce the $13.8 trillion in interest payments projected over the next decade. If anything, AI-driven productivity gains could reduce employment and tax revenue in the short term, widening deficits before any long-term benefits materialize. Vanguard's own 2026 outlook addressed this directly. They noted that AI's potential to boost productivity is real, but the investment returns may not flow to the companies currently valued at premium multiples. The technology might succeed while the stocks fail. Technology is a tool. It amplifies existing trends. If fiscal policy is sound, technology accelerates prosperity. If fiscal policy is unsustainable, technology does not fix the underlying math. The third objection: American exceptionalism makes us different. Every empire believes it is exceptional right up until the moment it discovers it is not. Rome was exceptional for 800 years, the longest-lasting empire in Western history, a civilization so dominant that we still use its legal concepts, its calendar, its alphabet, its political terminology. Rome fell. Spain was exceptional when it controlled the flow of New World silver, the richest nation in Europe, an empire on which the sun never set. Spain declined into a second-tier power. Britain was exceptional when it ruled a quarter of the world's landmass, the workshop of the world, the financial center of global commerce. The pound sterling was the reserve currency for over a century. Britain lost that status within a generation after World War II. American economic dominance is not a law of physics. It is a historical circumstance created by specific conditions following World War II. The United States emerged from that war with its industrial base intact, while Europe and Asia lay in ruins. That advantage has been eroding for decades as other economies rebuilt and grew. China's GDP in purchasing power terms now rivals America's. The Eurozone collectively represents a larger economy than the United States. The conditions that created American hegemony are not permanent. None of this means America will collapse tomorrow, or next year, or even this decade. But exceptionalism is not a strategy. It is a belief, and beliefs do not pay interest on $38 trillion in debt. The institutions managing the world's largest pools of capital are not operating on belief. They are operating on data, on projections, on risk models that account for scenarios most people prefer not to consider. When Vanguard recommends shifting from 60-40 to 40-60, they are not making a political statement. They are making a mathematical one. When BlackRock warns that fiscal imbalances have fundamentally altered portfolio risk profiles, they are not being pessimistic. They are being accurate. The objections sound reasonable. This time is different. Technology will save us. America is exceptional. They are the same objections people have made before every monetary crisis in recorded history. The pattern does not care about objections. The math does not negotiate. The debt compounds whether you believe in American exceptionalism or not. So what do you do with this information? You cannot stop the pattern. You cannot change government policy. You cannot fix the fiscal trajectory through individual action. But you can position yourself to survive it. First, understand the difference between real assets and financial promises. Real assets have value independent of government decisions. Land produces food regardless of what happens to the dollar. Commodities have industrial uses that do not disappear. Gold cannot be printed. Productive businesses generate cash flow in any currency. Financial promises depend entirely on the ability and willingness of institutions to honor them. Bonds are promises. Currency is a promise. Government securities are promises backed by the same government running $2 trillion annual deficits. History shows that when systems enter stage 4, promises fail. Assets endure. This does not mean sell everything and buy gold. It means examine your portfolio and ask what percentage depends on promises versus what percentage represents real productive value. Second, follow the smart money. Vanguard did not recommend 40-60 because they are pessimistic. They recommended it because their models show the risk-reward ratio for stocks has deteriorated. When the largest, most conservative asset managers in the world shift positioning, that is information. You do not have to copy their allocation exactly. But ignoring what institutions managing $9 trillion are doing with their own analysis would be a mistake. Third, diversify internationally. The United States is deep in stage 3. Other economies are at different points in the cycle. Some have better debt-to-GDP ratios. Some have younger demographics. Some have commodity resources that will hold value regardless of currency fluctuations. Vanguard's projections show international developed market stocks outperforming U.S. stocks over the next decade. That is not a prediction of American collapse. It is a recognition that valuations matter and U.S. valuations are stretched. Diversifying internationally means you're not betting everything on one government's fiscal management. Fourth, maintain liquidity but choose the form carefully. You need cash for opportunities and emergencies, but the cash should not be locked in 30-year Treasury bonds if those bonds will lose purchasing power over their duration. Short-term instruments. Money market funds. Assets you can move quickly when conditions change. The goal is optionality, the ability to act when others are frozen. Fifth, educate yourself on monetary history. This video is one data point. Read about Roman currency debasement. Study the Weimar hyperinflation. Understand what happened in Argentina, Zimbabwe, Venezuela, Turkey, Lebanon. The pattern repeats because human nature does not change. Governments face the same incentives today that Roman emperors faced in the 3rd century. The temptation to spend now and pay later is universal. The consequences are predictable. The more you understand the pattern, the earlier you will recognize the signs of acceleration. The earlier you recognize acceleration, the more time you have to respond. None of this is financial advice. I'm not telling you to buy or sell anything specific. I'm telling you to pay attention, to watch the data, to understand what $38 trillion in debt and $1 trillion in annual interest payments mean for the system you depend on. The $1 trillion repositioning that happened in December 2025 was not routine rebalancing. It was institutional recognition that the risk profile of the American financial system has changed. Vanguard called it a tectonic shift. Those were their words, not mine. The question is not whether the pattern will continue. 54 years of data show the trajectory. The question is what you will do with that knowledge. The institutions have made their move. They are positioned. They are prepared. Now it is your turn. If this video helped you understand what is happening beneath the surface, subscribe to this channel. In the next video, I'm going to break down exactly which asset classes have survived monetary crises historically and which ones got destroyed. The data goes back centuries. The patterns are clear, and some of the results will surprise you. Hit subscribe. Turn on notifications. Share this with someone who needs to see it. The pattern does not pause. The debt does not wait. And the window to prepare is not infinite.